Hey everyone, we are live. We are going to dive into a few different articles and charts and statistics on what is happening with interest rates. As you see the title of this video, uh, mortgage rates hit a 20-year high. People can't afford to buy a home right now and things like that. So we're going to dive into some of these statistics so that we can understand it better and so that we can position ourselves better going forward. So if you're new here, actually, let me adjust my camera real quick. There we go. If you're new here, welcome to the Money Level Show. I'm the host, Daryl Thomas. Here we think, act, and prosper, and we focus on changing financial trajectories and building legacies. And so I thank you for being here today. If you are in the comment section, be sure to leave a comment down below so that I can know that you're here, so that I can acknowledge you like normal human beings should do and everything. But we're going to go ahead and play this intro, and then we're going to get into what I am here to talk about today. So tune in.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Yes, you are now tuned in to the Money Level Show. We're also streaming on Facebook now just because I saw that was a feature that I could do, and I've been trying to get some of my Facebook viewers over to the YouTube space so that they can learn some of this financial education. So I'm bringing it directly to them on the platform that they choose to be on. And so I'm not really on Facebook as much, but I still connect with people there. So if you're dropping a comment or anything like that, I will be sure to like it or engage with it in whatever way. I see that we got a few viewers here. Be sure to drop a comment in the comment section below so that I can acknowledge you like a normal human being. So here we are, right? Mortgage rates have climbed up again above 7%. I actually know some people who have been in the market for a home, and they have been just very hesitant because of the 7% mortgage rates and the amount of payment they would have to pay on a home that you could have probably had like a $1,500 payment on. Now you're looking at a $2,500 payment on or higher. And so this is something we're going to look at today. So just to jump in, let's go ahead and I'm gonna go ahead and share my screen here. Boom. We're gonna go over to the Wall Street Journal. Now this is exclusive stuff, y'all. I gotta pay for this membership, and y'all actually getting it for free. You know what I'm saying? So count your blessings, right? So mortgage rates hit 7.09%, highest in more than 20 years. Interest rates hitting housing hard. Would-be buyers are locked out, and would-be sellers are staying put. Now, you got to ask yourself the question: why are buyers locked out? I mean, which we kind of just explained that, like the amount of payment that they have to pay for a smaller house. I mean, it's just like really unsustainable. And why are sellers staying put? I mean, sellers are like, if I sell my home and get another home, then I'm going to be in the same position as the buyer, and I'm going to have to get a 7% mortgage, even if I can cash out at the higher valuations that are on the homes. Like, for example, I bought my home in 2019. The value went up from it was a small home, 215,000. The value went up to close to 400,000. And I refinanced. Obviously, I was at a 5% mortgage rate. My payment at that time was about $1,500 a month. And then I refinanced it when the pandemic hit. Rates went lower, got in at a 3.125%. And my payment went from $1,500 to pretty much $1,100. So, it's like, okay, well, that's like something that you have to really think about, right? You have to think about like if you're a seller, right? And you're like, hey, I need to um, I need, if I sell this and I take this profit, then I'm going to be stuck in the same predicament and I'm going to have to, you know, get a higher mortgage rate. So that's not a good position to be in, right? I don't think that's a good position to be in. So, you really have to consider that. All right. So let's go ahead and jump more to the article. The average mortgage rate rose to 7.09%, its highest level in more than 20 years, according to data released Thursday by mortgage giant Freddie Mac. If you hear some of the ambience in the background of cars and stuff, like, it's hot in this room, so I got the window open. All right, sure y'all understand. The increase extends a lengthy stretch of high borrowing costs that has slowed the housing market to a crawl. This market, and the first time since last fall that the rate on a 30-year fixed rate mortgage rose above 7%. A year ago, rates were around 5%. The housing market is part of the economy hit most directly by the Federal Reserve's high rate policies. The resulting slowdown of refinancing and purchase activity has battered some mortgage lenders, leading to tens of thousands of layoffs in the industry and weighing on economic growth. All right, so here's a chart of the 30-year, the average rate on a 30-year fixed mortgage. So, as you can see, 72. Rates were at 7%. Obviously, then you could buy a home, right, for what, less than 10,000 around that time. So, that 7%, it may been expensive at that time, but obviously wages were lower. But if you held that mortgage over time, like, the devaluation of the dollar would have paid that off really nice. So then you get to the 80s. We talk about this all the time. Paul Volcker came in and pretty much hiked rates, let the market hike rates. Rates went up to actually around close to 20%. If you watch my recent interview with Frank Trotter of Battle Bank, he actually said his first home, they got in at 19%, right? So that was very, very expensive, especially during that time. High payments and high interest on these mortgages. So as you can see, then once the Fed ended up breaking the back of inflation, right? Inflation comes down, then they start cutting rates. So rates start coming down, as you can see, and then they kind of, normalize, back to like the 70s, the early 70s here. And this is when I believe Greenspan was in somewhere around here. And as you can see, the Fed just keeps cutting rates, right? So what happens when the Fed cuts rates? The Fed cuts rates, it makes borrowing cheaper for many people, but you also accumulate a lot of debt. So you have a lot of consumer debt that accumulates, a lot of corporate debt that accumulates. Government debt accumulates. And so that's what happens when the Fed, continues to lower rates. And that was a way that they fought like recessions and tried to like minimize the impact of recessions and things of that nature, right? So as you can see, the Fed has been cutting rates since the 80s. And Rick Rule talks about this a lot. He says we've been in a 40-year secular decline of interest rates. And so he's expecting that interest rates are going to stay higher. And so this obviously isn't the Fed funds rate, but as we can see, with interest rates, this isn't the Fed's fund rate, but they have nowhere else to go. They've already reached zero bound, which we'll go look at the actual Federal Reserve interest rates, the federal funds rate. So now you got mortgage rates popping back up to 7%, and who knows how long they'll stay there, and and how high they'll go, right? So now I'm gonna just jump over to the federal funds rate. This is the Federal Reserve's interest rates, right? So pretty much the Fed sets the federal funds rate, and then you have the banks who will usually charge more than what the Fed is charging them, right? So that they can get a profit. So that's pretty much how this works. I don't know who's viewing with me right now. Be sure to drop a comment. Love to engage. So as you can see, the Fed funds rate, it looks just like the other chart with the mortgage rates, right? It looks pretty similar. So as you can see, like the Fed got to zero bound after the global financial crisis in 2007, 2008. What they did was they hiked rates, they paused, and then they cut rates. So that's usually the the formula they use. They hike rates, they pause, and then they cut rates when something goes really bad, right? So here you can see they cut rates after the global financial crisis. Here they cut it right after the pandemic started. Here they cut rates during the dot-com bubble, right? Here they cut rates during the 1992 stock market crash as well. I think Russia had some big issues then. Um, so yeah, so that's pretty much how the Fed works. So pretty much they set the base rate, and then the banks usually charge more on the mortgage than what the Fed actually has the rate at. So as you can see, interest rates have been declining. They can't go any lower than here. They've been at the zero bound for a while. Here they were printing a lot of money and such. And now the big issue is that we have inflation. So we haven't had inflation since rates were up this high in the 80s, right? 70s, 80s. And inflation was super low during these times. And then now we have inflation again, and rates are only at 5%. And so that's pretty much the basis for like rates going higher, because inflation is staying more stickier. So nevertheless, I mean, people can't afford, these homes at 7%, right? Why not? Why can't people afford these? I shared this chart in that interview. Be sure to go check that out. So this is the first chart. This is the gap between productivity and a typical worker's compensation and this shows the increase since 1979. The interesting part is that this increase really started, after we were taken off the gold standard, made us be more fiscally responsible with the money, with the budget. Now we're running over, almost a $2 trillion budget deficit, right? So the gold standard restricted us to how much money we could actually print, and then when we would print a lot more, other countries would come into the United States saying, demanding their gold back, pretty much. So that was, so when the gold tie was severed, you begin to see all these other things, right? There's other things like China was brought into the World Trade Organization, and so many of the jobs were offshored to China, where they could get the labor a lot cheaper than what they would pay Americans. All these things, and so then you just see like the productivity and the hourly compensation has been pretty flat. Like real wages have not been really increasing. So when you take, like, you may see the nominal number of like, oh yeah, well, I'm getting paid more than people got paid then, but you have to adjust it for inflation, right? So if you don't adjust it for inflation, then you're getting a misleading number, because back then in the 80s, right, you could be getting paid what, $6 an hour, $7 an hour, whatnot, but your purchasing power was a lot greater than it is now. You can actually afford a home at 7% mortgage rates. At 20% mortgage rates then versus now. And so you have to see that the wages are flat. They've been flat because inflation has continuously been increasing. And this is inflation that isn't calculated in the CPI. Like inflation such as medical expenses, inflation such as housing, not necessarily rent, but the housing prices, inflation such as you got medical expense, housing. You got many other things, obviously. Gas prices have went up. I remember when I was a kid, gas was 80 cents a gallon, 80 something cents a gallon. Now it's, $5, right? So all of that increases. So our money continues to get worse, right? So that's pretty much how that works. So, and then when you see this gap here between productivity and hourly compensation, the gap went to the corporations in the top 1%, right? So they saved a lot of money paying less wages, getting cheaper products. I mean, cheaper materials, right? I mean, if you're getting the materials directly from China versus like having to pay some American in the factory, a decent wage or whatnot to get the materials and such, like, I mean, you're making more of a profit. So that pretty much, that gap went to the 1%. And this is how we're going to look at this now. Now, when you look at this, right, you see, since this chart goes back to 89, but these are the assets held by the top 1%. So as you can see, like, this has just been increasing. They hold majority of the wealth, right? This continues to increase. And I still can't even interpret this number. I mean, millions of dollars. I think what this is, 50,000 million or 50 million. I think that's what it is. Somebody do the math on that. I know I got some viewers there. If y'all want to do the math, please do it. But that's a lot of wealth that have been, pretty much obtained there. So, and then you can see, let's look at the wages. These are part of the wages too. So 1984 current dollars. I mean, you can make $22,000 a year. This is the average medium household income. And then you get to now, now it's at about 70,000. So you're like, okay, yeah, well, people get paid more, and that's where the misleading is, because it's not factoring in the real wages, right? That means adjusted for inflation. So if you adjust this for inflation, I mean, you're looking at, $38,000 a year, $37,000 a year, so I mean, that's not good, right? Right. I mean, and we can even look at the the real housing data, so like, that's, pretty alarming. I'm trying to figure out which tab am I sharing right now. Okay, I'm getting kind of lost over here. All right. So yeah. Then let's go ahead and look at the this is the consumer price index, purchasing power of the consumer dollar. So ever since the dollar was created in 1913, this is the purchasing power of the dollar. So it's lost over 95% of its value. So if you look at that, and it just continues to go down, go down, go down, go down. I mean, until it doesn't exist anymore. That's just the nature of history, the nature of fiat currencies. So that's why people say buy gold, buy scarce assets, because gold holds its purchasing power versus the dollar doesn't. And usually the dollar can hold its purchasing power towards certain assets. It just kind of, you have to be very strategic with it. So like, if you had the dollar in October of last year when the stock market was just getting killed, then it held its purchasing power according to stocks, right? Or gold. I mean, even gold took a dip. So the dollar held its purchasing power then, and you could have bought them cheaper. But according to other real goods in the economy, it did not. So the dollar continues to lose value. And this is why people can't, afford these homes at 7% mortgage rates. So what can we do about it? What can we do? First thing, I mean, we definitely can own precious metals. Just like I said, I mean, gold has maintained its purchasing power, while the dollar has not maintained its purchasing power. Scarce assets obviously go up in value. Many people view Bitcoin as a store of value now. I'm kind of in that camp, and this is kind of, kind of back and forth a little bit, but I'm more a gold bug, but I do invest in Bitcoin too. None of this is financial advice. And I see more people coming around to it, like Doug Casey. Like he's like a Bitcoin fan now, but he still loves gold more. So I'm kind of like that. So you want to hold real assets. And you gotta spend less than you earn. Less is more in this environment. Less is more, and wait for opportunity. Wait for opportunity to be able to take advantage of, because even though housing prices are up the way they are, that doesn't necessarily mean they're going to stay that way forever. And obviously, I have my real estate license, and many real estate agents are going to tell you what you want to hear, right? Or they're going to tell you, they're going to argue for their bias, right? They have to get the sale, but hey, if you look at these macroeconomic factors, with the Fed, the government, the amount of debt in the system, even liquidity drying up amongst like the working class people, and the banks are restricting, credit to borrowers, things of that nature. Like if you factor into all that, you're like, okay, yeah, anything is possible right now. So that's very important to note. So I hope you all are doing well and everything. Sorry for such a grim picture, but definitely got to prepare yourself, educate yourself on just finances, and just knowing how to manage this environment and stay disciplined throughout the process. For me, that's a struggle at times, but I'm in it to win it. So that's why I want to stay disciplined. So yeah. Thank you all. And then I also want to let you all know about the New Orleans Investment Conference before we head out. I have to show this quick commercial. Be sure to check it out, because, if you click the links that I have in my description, you will be able to go to the New Orleans Investment Conference and check that out. It's going to be really good. So check it out. Hello, everyone. Sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview. All right. So we're back. So appreciate you all for tuning in today, watching the show. I know I get on late at night sometimes, and but that's when the kids are asleep, so that's when I'm on. So all right, you all take care. You all have a blessed night. All right.